All right. What is going on, people? What is up, guys and gals? Drop some emojis in the live chat if you can hear me. We are live, yes. I am a noob when it comes to streaming. All right. Well, let's go ahead and get started. So, first off, I just want to say I put up a few videos over the past couple weeks. The most recent one was yesterday, last night. Put up a video about my value investing style, so I encourage you to check that out. I plan to put up another video talking about sources and go in depth into my screening process. So kind of jumping around here a bit, but hopefully I'll get that video up soon, and you can kind of watch those videos alongside or as a complement to my other videos. And I think also from here on out, I'm going to stick mostly to value investing and maybe go back to the live stream where we kind of talk, some daily options trades, stuff like that in general. But that'll be kind of secondary. So that said, welcome back, everyone. Today we are going to talk about some potential value plays. And as you can see on my screen here, we got a little Bill Huang poking up from the bottom. I'm looking at four companies in particular. Earthstone Energy is an oil and gas company. Upstream, Stellantis is a big auto manufacturer based out of France, I believe. Visa, everyone knows Visa, and Nintendo. So I'm going to kind of look at these. I've already done a good amount of research on each of these companies. Otherwise, frankly, I wouldn't be talking about them during a stream. So I'm going to kind of touch on what I find interesting about them, maybe look a bit at their financials and see what's going on with the companies today, and if there are any catalysts that might be materializing or expected in the future. So with that said, let's get started. All right. We will start with, oh, look at that. Google's not working right now. This is my watch list, or part of my watch list. And Google's wrecking my watch list. That's okay. So why don't we start with Earthstone Energy? So I'm just going to jump straight to financials. We'll do a little overview here for those who haven't heard of the company, because I hadn't either. So Earthstone Energy is an independent oil and gas company engaged in acquisition, exploration, development, and production of oil and natural gas properties in the U.S. The company's asset portfolio includes the Midland Basin of West Texas and the Eagle Ford Trend of South Texas. So it says how many wells they have open, but that's a bit outdated because they just made a big acquisition. But let's check out the financials real quick before we talk about the acquisition they just made. So first thing I want to look at, this is ticker.com, by the way, for those of you who are new. I like using this website. It's free to use. I believe you do need an account, and they do hide some information, as you can see, these little lock boxes, but no sweat. I get most of what I need to see. So yeah, that's quite nice. But here you can see estimates going out to fiscal year 2023. So I like to base my, projections, my analysis off of the next year, maybe 2 years. Year and a half is perfect, that gives me a good look at the future in terms of sales and earnings the company's expecting to make. So we can look here. We got 2023 estimates. I'm going to skip this year because that should almost be locked in, we'll say. I know oil and gas gets volatile, so I'm sure the revenue is going to be different than 1.6 billion. The free cash flow different from 590 million. But I'm also somewhat certain that as we're getting close to the end of the year, these estimates aren't going to be too far off. So I'm not really going to base my analysis, my projections off of just this year when the year's about to end. So looking at 2023, we see a pretty good increase in revenue, 32% from this year. We'll go ahead and ignore that 289% increase for this year for now. So we got 32% increase in revenue next year. EBITDA is looking nice, a 38% increase in EBITDA. And free cash flow, so these are the three metrics I'm going to look at first and foremost. Free cash flows, $825 million. That's about a 40% increase. So margins improving quicker than revenue. Everything looks pretty solid. So these are just projections that are coming from Bloomberg. So one thing I like to notice from ticker.com is you can hover over the estimates and it'll tell you how many estimates it's based on. And as I mentioned earlier, I'll do another video where I kind of dive into the sources, ticker.com, just, go real in depth on specifically what I look for. But until then, I should have that video up soon. But until then, I'll just cover a few details here and there. So you can see number of estimates, 5 estimates. That's not a lot. EBITDA, 7 estimates. Free cash flow, 5 estimates. So maybe if I'm incorporating these projections into my own analysis, my own valuation, maybe I'm going to be conservative. Maybe I'm going to drop this 824 down to, I don't know, maybe I'm going to cut it by 20%, something like that. And then I can always mess with it however I want. I got a nice little setup to do that, And obviously, this company is making money based off of oil and gas, and LNGs are included in that as well. LNG products going to Europe, right? Mostly Europe. So that's going to be volatile. So looking out a year and, I guess really these estimates are from at least a few months ago. So this is looking out about a year and a half from now. So things are bound to change. Oil and gas prices are bound to change. So just right off the bat, I already know oil and gas is very cyclical. I know gas prices, LNG prices are going crazy. Who knows what oil prices are going to be a year from now? So I just want to be conservative no matter what. These values look pretty nice, really high growth, and that's good. And I'm going to note that, and I'm going to say very high growth on the horizon. I know is because of an acquisition. We'll look into that. But first off, foremost, I'm always going to want to be conservative, particularly when looking at these volatile industries that are highly cyclical. So, I just got a trade fill. All right, very nice. Adobe. All right, so let's take a peek at their financials. And then again, we'll take a look at the press release for the acquisition. So one thing I like to do is I like to sort of guess what's going on with the company just by taking a glance at the financials. The big 190% increase in revenue for last year, that to me it's obvious there must have been an acquisition, there must have been an increase in assets, so in product producing assets, something must have happened. I know oil and gas prices moved up a lot, but that's a hell of a move, right? So I like to kind of try to guess what's going on. It's pretty helpful to just glance at financials and just automatically be able to figure out what the company's up to. So another thing I'll note are operating margins. So no surprise here, they're all over the place. The company it looks like much smaller in the previous years, 100 to 191 million in revenue. Last 12 months, we're looking at 923. So big changes. So right off the bat, I'm thinking, let's say, nothing about this company. Right off the bat, big transformation happened. It's likely that the historical trend is not applicable to this company going forward. Not that there was a trend. I mean, look at these margins, right? So right off the bat, I know it's oil and gas. It's cyclical. Something big changed. I know I'm not going to be able to make a decision just by looking at this year's growth and say, okay, take all my money, right? So just a few things that I'm going to know just from looking at revenue and operating margins. So I'm going to skip all this other stuff. I don't care about net income because that's GAAP, and GAAP literally stands for Generally Accepted Accounting Practices. So I want to be specific, not general. EBITDA, I'll drop down to that because that's an industry standard. And that's looking like $476 million over the past 12 years. Or I'm sorry, over the past 12 months. And that would be sad. And that's a pretty good increase. It looks like they've been EBITDA positive, which is nice. So, yeah. A lot of people for oil and gas, they'll look at their capital expenses and expenses related to exploration and production, right? I like to just keep it straightforward and simple. Use the same metrics for all companies, so that's why I tend to highlight revenue, EBITDA, and particularly free cash flow, which I'll get to in a second. And again, for those of you who are somewhat new to looking at financials, I encourage you to do a bit of research. Investopedia.com, that's a great resource. Or you can ask in the comments. But, if you don't feel like waiting for me to answer, Investopedia.com, there are plenty of really good resources to help you out there. And check out the video that I posted about value investing. Now, let's take a look at the balance sheet. All right, so one thing I'll look at here are current assets and current liabilities. So, looking at this, 269 million current assets, 432 in current liabilities. Not very liquid right off the bat. I would want current assets to be higher than current liabilities. However, this is oil and gas. They could have some interesting things going on, like say these other current liabilities. Those might be hedges that are part of basically their transactions, right? So maybe what's included, I assume what's included in this 279 million amount is an unrealized loss on hedging their product, but that's just going to be subtracted from the actual amount of money they're making when they sell. So that shouldn't be too much of a problem, but we can always dig in further if we're not sure about that. But in general, I will want to look at current assets to current liabilities, net working capital, current ratio, etc. However way you want to look at that. And the other big one that people don't seem to talk about too often is debt. What is their current debt level? Looks like 935 million. That's obviously gone up a lot. So here we're seeing all the signs of a massive acquisition, even though we haven't gotten to that part yet. Even though, say, you have no idea what this company does, you can just look at the financials. You can tell something big happened. So this 935 million in debt, how do we feel about that? Let's look back at EBITDA. 476. So 476 to 935. Okay, so we're looking at under 2 times debt. That's not bad. That's acceptable. However, if the business were to, say, not make as much money as expected going forward, if natural gas prices tank, oil prices drop, this EBITDA figure is definitely going to go down. So I'm going to note that while debt to EBITDA is fairly low, I'd say under 2 times is pretty damn low, especially for an oil and gas upstream company. And in general, I want to see something under 3 times. It's going to depend based on whatever company, whatever industry you're looking at. But I do see these previous EBITDA amounts, and if EBITDA were to drop by a significant margin, that debt level starts to look a lot higher, just relative to their earnings power, right? So I'm going to keep that in mind. I'll also like to compare that debt figure to their forward EBITDA, which we took a glance at in estimates. But before we go back to estimates, let's look at the statement of cash flows. So first thing I notice is good cash from operations. That's obviously gone up a lot. So earnings are just going up across the board. That's good. Nothing abnormal. Nothing to be super cautious about, right? Stock-based compensation, I like to look at that too. That doesn't seem too high. Let's see, 18 million versus 923 million. Okay, that's not too bad. In general, I want to see that below 5%. Anything above 5%, I think management's being a little greedy, and which rules out a lot of companies. But I'm okay with that. So I want to look at free cash flow, which is cash from operations less capital expenditures. So there's that massive CapEx figure that has been implied up until this point. They have pretty high CapEx every year prior, and it looks like negative free cash flow every year except 2020, which is pretty interesting because 2020 was kind of a bad year for a lot of oil and gas companies. But this is definitely going to require some further digging on my part, just to see what they're just to have an estimate of what their free cash flow is going to look like. We have some estimates in those in this estimates tab here in ticker.com, but again, I do want to be conservative. I want to know that they're going to make that this cash from operations number is going to go up a lot higher, and that this CapEx figure is more or less a one-time thing, because I'm assuming this big investment they're basically setting themselves on a path for good profitability, and maybe they're not going to be doing that too often. That's what I'd want to know. So those are the main things I'm going to look at here. We already looked at debt. Another thing I'm going to pay attention to, which you'll also notice on the balance sheet, is preferred stock. And typically, I stay away from companies that issue preferred stock. However, I already know that the holders of that preferred stock, they already converted all their shares, which unfortunately it means share dilution. So all of these things I'm noting. Debt looks okay to current earnings, but earnings could drop. No positive free cash flow yet. Big capex. They issue preferred shares. Honestly, that's a lot of red flags. But we can keep digging into this because maybe there's something going on here. Maybe this all makes some kind of sense, right? And we can always be very conservative when thinking about an entry price to a stock like this if it looks like they're going to make a lot of money in the future. So one other thing before I forget, you will see down here total shares outstanding on the date of filing each 10K. So, because we're looking at annual, right? That has gone up dramatically. So a lot of the upstream companies, they do tend to issue shares. And that may be a thing of the past because they weren't really making a lot of money. You can kind of tell. We look at cash from operations. It was a small fraction of what it is today, right? So, they had to issue shares. They had to issue debt, right? They're probably highly leveraged, diluting every year, right? So here we can see a good amount of share dilution, particularly over the past year. So it looks like they made a big acquisition. They used cash. They issued some debt. As you can see here, long-term debt goes from 115 to 320 to 933 million. And they issued a bunch of shares, probably mostly through preferred shares. So the red flags are mounting up. But like I said before, we can dig into this further. So I'm going to go back to estimates just so we can take another glance. So here, I think we have a bit of a different figure for 2021 for free cash flow. I see 100 million. Let's look back. 100 million. Okay, so that's a bit different. 131 minus 88 is not 100. So, okay. So I'm not sure how they calculate that free cash flow figure. But as I mentioned earlier, I'm going to be conservative on every figure that I look at here. But we do have a big ramp up in sales, big ramp up in EBITDA, free cash flow, just as we noticed earlier. So looks like based on these estimates that the recent acquisition is definitely going to pay off. Not too many estimates, but I'm going to assume that these 5 to 7 analysts that looked at this company aren't actually insane or, just in cahoots with management here. So from here, one last thing I want to check before I do a deeper dive is I want to compare this free cash flow figure, specifically free cash flow, this 825, to their current enterprise value. If I go back to overview, it'll say their enterprise value up here on the right, and that's 3.2 billion. So that, what did you say? 825. So yeah, 825 million expected next year versus the 3.2 billion. So that's what, over 33%, maybe 35%. That's a really high free cash flow yield. Even if we brought that down, I cut that in half. That's still, at least 16%. So that's pretty interesting. This is a sort of, so far, if this company can pull this off, right, this level of free cash flow, and oil and natural gas prices don't just suddenly tank, maybe the markets will appreciate this company much more favorably than they currently do, right? So speaking of which, let's look at valuation. Here we got a nice valuation tab. So I'm pretty lazy, so I like to look at all this stuff first before I start to dive into a company and start analyzing them. So I believe this free cash flow yield is going off of market cap. I prefer to go off of enterprise value. It's actually standard for myself, and I'll include a little link, a research paper that explains why enterprise value is the way to go when looking at companies. And that's also an industry standard, by the way. So this is pretty high, 53%. But looking at that 825 figure, we decided it's about 35%, right, of enterprise value, looking at 2023. So that's pretty solid. Now, how long has this company been around? Okay, let's bring up the price chart here. Okay, so they've been around for a while. They went through the boom and bust in oil. Okay, so these guys, they're not exactly new to the industry. So that's interesting. Maybe they got some people that actually know what they're doing. All right, so company has decent history. Issuing a lot of capital to finance the recent acquisition and potentially big money on the table. That's what I'm telling myself right now. Just sort of mental notes. So if we look at the valuation, they have not been cash flow positive more than half of this time period. So one thing I like to look at is I like to see this trend. And maybe we'll start when they actually went cash flow positive, which interestingly, that was in March 2020. So that's when oil was taking a massive hit. So I see this 52.5% number right here. And we'll just ignore it how ridiculously high that is for now. Because typically I have a 5% hurdle rate. So that obviously this is well above that. But we're just going to ignore how high it is over these years for now. And I just want to see how it's been trading. So EBITDA, enterprise value to EBITDA, looks like we got a low of 1.95 times over the second quarter. And we got a high of close to 7, about 6.9 times over the second quarter, from the second quarter in 2020. Okay, so looks like we're at the low end, but this company wasn't really making a lot of money back then, so it's not surprising that the valuation looked high, right? With cyclicals, though, the saying is, don't buy cyclicals when the PE is low. Buy them when the PE is high, because then they start to look like a company like this, right? And the valuation looks really, really strong. Then they start making a lot of cash flow. So if you had bought, for example, in 2020, when there were signs of life, right, that the company was going to turn itself around and they knew oil and gas prices were going to go up, they were going to make some big acquisitions. You bought at, I don't know, let's say $3. And then you just held, and oil and gas, they had a really big, particularly oil, had a really big boom through 2021. So you bought at $3. This thing was a multi-bagger. And you could have just held for a while, maybe trimmed, and average price getting out $10, even though it's trading at 15. That's not bad. Over 3 times your money in a year. So yeah, that's kind of what we're looking at here, or what we're looking for, rather. But I am noting that maybe that doesn't repeat itself, right? So overall, I still want to be conservative. I'm still not thinking this is just a home run, and I'm just going to 3 times my money again over the next year, right? So overall, looking at valuations, the trends, maybe it's not so helpful because it's a completely different company, and I'm very well aware of the fact that cyclicals can look cheap, even if their forward guidance, how much money they're going to make in the future, isn't going to be nearly as high as what it is today. So overall, still very, very cautious. Now, let's go to their press release. I'm going to zoom in a bit. Okay, so Earthstone announces closing of Titus acquisition. Expands operations to highly economic northern Delaware Basin area. Okay, so this was, I'm assuming, this was their big acquisition. Let's see what it cost them. Introduce a term loan tranche. Let's see. So this says current commitments of $1.2 billion for their credit facility. So it looks like, let's compare their outstanding debt just to that. They had $935 million. Okay. So 800 at 1.2. Maybe they're using, maybe it's just this credit facility where they're drawing that 925 million from. Let's see. Consideration for the acquisition was 575 million in cash and approximately 3.9 million shares of common stock, net of preliminary purchase price adjustments. At closing, Earthstone paid cash consideration of approximately 535 million, net of the 40 million deposit made in June. Okay. So now we have identified the acquisition. Some share issuance, and I know there was some preferred stock issuance. So I kind of want to see something on that. I do know it was already converted, which I believe translated into a good amount of shares. And I do have some notes, so maybe I'll just have to skip to my notes. Maybe we won't find it right here. Increase in the borrowing base. So borrowing base is just the collateral they have to hold just in case the company doesn't make it. And then the bank has claim to that collateral. So this is saying that they had to increase that collateral. So that's just the bank saying, listen, if you want a bigger amount, you're gonna have to put up a lot more inventory, a lot more assets. So that's all it's saying. It's standard. And the bank is taking risk on a company like this. That's for sure. Let's see. Production guidance. First half 2022 actual. This is production barrel equivalent. So this includes oil and looks like natural gas or NGLs. So got about 56.5. What is that? Okay, 56,500 per day. Third quarter 2022, which is almost over, looking at 86 to 90. And then fourth quarter, 96 to 100,000. So, okay. So they're increasing production a lot. I'm going to guess that the Titus acquisition was already being incorporated because I'm going to assume that this wasn't the case beforehand, this whole 56 number, and that maybe they started getting more production online through the third quarter. Main reason I'm assuming that is because we could just look at the ramp up in sales, right? So why did sales go from 420 to 923 last year to the last 12 months, right? So I'm going to assume they've been incorporating that acquisition, and now it's fully integrated, right? So now, okay, so that's for each quarter. That's the average for each quarter. And then fiscal year 2022. So that's a pretty big jump from the first half. 56.5 to, we'll call it 74, just to be conservative, a little bit on the low end. This doesn't exactly tell us what the earnings will be, right? Because this is just production and the prices are going to change. And it's really hard to project actual earnings for these oil and gas companies because nobody knows what oil prices, what natural gas prices are going to be, even at the end of this year, right? So, but they will give guidance on production, and that gives us an idea of what's coming online. Do they plan to increase production? And even if prices do drop a bit, at least their production is going up, so that should offset lower prices should that drop occur. So, CapEx. Okay, so let's consider ourselves savvy on the acquisition. Big acquisition, issuing shares, issued preferred stock, issued debt, right? Issued everything. But looks like production is increasing a lot. So we're going to assume that the estimates that we looked at back here are somewhat sane. We'll say that. Okay, so let's close that out. And then let's go to my notes. I like to just put notes straight on my watch list, and it just makes things very simple. I'll just put comments. I like using Google Sheets because I can use it anywhere. I don't have to worry about any. I guess I just got used to it a long time ago, switching from Excel, and it does seem easier to use a lot of the time. So you can see my first comment. I said, "What is wrong with this company?" Because I noticed the valuation was incredibly low. That was the first thing I noticed. So anytime you see a company like that, if you're looking at the same multiples that I look at, that really should be the first question you ask. What is going on with this company? Why don't the markets want to pay more for this company? So right off the bat, I'm cautious before I even looked at the financials, right? So just going to read off some of these notes here. They might be a little too small to read. So one thing I noticed is that management seems to want to continue their acquisition strategy. So that's a note that I got from reading some specific management comments, and they are prioritizing debt reduction, which, looking at how they financed this recent acquisition, I believe they made one or two others in the past. Based on the pattern that they've set, they will issue more shares. So there was a good amount of share dilution. I mean, we looked at the shares outstanding, right? And those were going up a lot year over year. So that dilution really has to be considered, because the stock could be incredibly undervalued today. But what if they dilute the stock by 50%? Your valuation's cut in half, so we always have to consider that. Another note, Royal Bank of Canada, I saw an analyst report from them, and they think that they're going to issue a small dividend starting in 2023. I'm not exactly going to consider that in my analysis. Besides, I'm looking at what cash flow is available for shareholder returns, which could very well include a dividend. But in general, I'm not too picky on what specifically they do with that cash flow. So it could be shareholder returns, it could be paying down debt, reinvestment. I just want to know that there's a good cash flow yield. So, and plus the dividend would be small. So there are some cases where I'm really going to care about dividend, but not in this case. Okay, and then I know a few risks. So one risk is the affiliates that they have. So it's NCAP Investments and Warburg Pincus. They previously owned about 43% of outstanding shares, which is a ton. So right off the bat, I'm thinking, okay, what happens when they sell? The share price could crater. It doesn't matter how undervalued it is. If these guys if they're out, share price could just tank, right? And after reading a recent filing, I noticed that there was a big sell. That's when they converted they did convert a good amount of preferred stock and into shares, and in common shares, that is. And now the combined ownership is 36.2%. So that's still really, really high from two entities. And based on what I've seen and what I've read, these companies, they kind of look like buddies with management, with the main company. I don't really like that unless they're just like, some good guys that are just helping the company, giving them a good deal on transactions, on distribution, whatever the case is. But here, it seems like they're financing most of this company's activities, their acquisitions. But it seems like they're getting a pretty good deal with those preferred shares, and they're able to sell those preferred shares whenever they want, right? It seems like. So I'll skip that note for now. So I note that there was a large issuance of preferred shares. 25.225 million common shares were converted from preferred stock on July 6th. So I do include that in my analysis, and I do note that additional issuance and subsequent share dilution is expected, as those affiliates seem to have a substantial influence on the company. And for them, I think the preferred share issuance, that is a nice benefit for them, because otherwise they would say, you know what, we're just going to issue common shares, right? And then they flood the market with 25 million common shares. The stock price is going to drop, right? Instead of that, they say, let's issue some preferred shares. Maybe you get a little dividend in the meantime, and then you just convert them whenever you want, So this could be done at any time that the affiliates want, whenever they like the price, right? So it's kind of put into the hands of those investors versus the company in regards to how to time that share issuance. So to me, it's kind of like they're giving that benefit to those specific investors, not the rest of the market. So this is arguably the biggest red flag to me. I don't really like to see this. I don't like to see preferred shares at all. But I guess we'll just consider it just regular common stock dilution, since that's what those affiliates seem to want to do in the first place. And I will assume that as the price goes up, they're going to continue selling. I don't see any reason not to assume that. So preferred shares aside, another risk I know is that they're shifting further to natural gas. And in their sales mix, it was currently, last I checked, it was currently about 40% natural gas, which included LNGs of about 20%. So they're going further into natural gas. I think a lot of investors and maybe a lot of analysts would prefer the opposite. Take advantage of very high natural gas prices right now, right? Take advantage of the LNG prices you can get by selling to Europe. But if you're shifting further into that, you're essentially making the bet that those prices are going to remain very high, or at least, high enough to where you're still making good money. But that also makes your earnings, your potential earnings, very difficult to project, because natural gas has definitely been more volatile than oil. So I see this as a risk. There's a lot of money to be made, but it makes profitability very unclear. So I definitely assume that is a pretty good risk to the company. And, they could make, like I said, they could make a lot of money from selling LNGs. Maybe natural gas prices do stay very high, for the next at least 6 months, right? Maybe even a year. Who knows, right? But that's a risky bet to make, in my opinion. So far up to this point, if I had to recap, this company does appear very undervalued, but if I'm going to make a play, it's going to be a small one. Let's see. Okay, and then I just note management said they're expecting CapEx to increase due to inflation and acquisition-related costs. So costs going up, margins are still going up in a big way, but perhaps there will be some pressure on those margins going forward. So I have them listed as a growth stock, classified as a growth stock, which I think makes sense. Their forward 3-year CAGR for revenue, compounded annual growth rate, is 146% based on the estimates from ticker.com. Let's see. Okay, I see a few questions. I'll get to those in just a second. All right. Real quick before I do, I want to look at their forward projections, and their forward multiples. So based on ticker.com, for 2023, we're looking at a 46% free cash flow yield. That is monstrously high. So that's very, very good. But again, we're using that. We're just going to assume that their estimate is a good one, right? Debt to EBITDA will be 0.4 times. It's very, very low, particularly for an oil and gas upstream company. And to me, if they maintain it that low, management has already indicated they're going to make more acquisitions. So I don't mind acquisitions. Keep growing, right? But I don't know if I want them to continue to be very acquisitive each year, right? So for the next several quarters. And then as time goes on, I say, well, you're continuing to invest heavily in oil and gas. But oil and gas, it might come down at some point, particularly natural gas. So oddly, it's okay that they got here by making a big acquisition, but if they continue to do that, I see it as a greater risk. So I do want to keep a mental note of that. EV to EBITDA 1.1 times. I think the industry average is something like I don't know, it's above 10 or something like that. So that's incredibly low. So let's go to my little projections, my inputs over here. And again, these are straight from ticker.com. One thing I'll note is this column right here is the share buyback rate, and I make it negative if I'm assuming share issuance. So I put a big fat negative 38.5% share issuance for my assumption. So basically, if I take that away, we're looking at their current shares outstanding right here. It's 108 million. So I'm assuming that they're going to issue shares in a big way. I got this figure this is based on how many shares they've issued in the past to finance an acquisition. So I'm being pretty conservative because that might be that could be zero. You know, maybe they don't issue shares. I think they probably will, right? But maybe this is only 20% and, you know, outstanding shares go to 130 instead of 150 million, right? But I still want to be very, very conservative. So the last thing I'll do here is I'm going to adjust some of these figures over here. So I have a little multiplier here. I call it my little sensitivity factor. So 1 times means I'm not touching these, right? Everything times 1. So let's drop by a third, and let's see what happens to these multiples. So free cash flow yield goes to 31%. Debt to EBITDA is still really low. Enterprise value to EBITDA still very, very low. You know, far below like 10 times, for example. Let's say the markets crash and oil and gas prices tank. Let's multiply by 20%. We're still looking at almost a 10% free cash flow yield. So if they're able to pull this off, even with a lot of share dilution, because this is including that tremendous amount of share dilution. Mind you, if they do this, their sales are, all things considered, sales should increase, free cash flow should increase. So I'm penalizing them without rewarding them for the potential increase in sales and free cash flow. So let's consider them these estimates. Let's say that's what it's going to be, even if they make an acquisition, and I'll include a potential acquisition in that the share issuance figure, right? So even if let's make it a quarter, right? Okay, we get above 10% free cash flow yield. I think that's actually good, and multiples are still looking nice. So overall, I'll change that back to 1. Overall, the way I'm looking at it is this yield is really, really high. I'd want to see at least 10% in order for an oil and gas stock to look kind of cheap, right? So that's clearly far above 10%. We're looking at 46% right here. So from a valuation perspective, specifically multiples, they look very, very cheap. Very, very cheap. Too cheap, you might say. When we consider all the other factors, all of my notes here, preferred share issuance, perhaps continued acquisitions, even past a year out from now, right? The little buddy partnership they have with their affiliates. I think there are a lot of qualitative risk, we'll say, which I don't really like. So for this one, I might just I want to limit my risk. I don't want to expose myself too much to the stock, so maybe I buy calls. So I might look at, say, like June 2023, maybe 2024. I don't know about just buying shares because, again, I do want to limit my risk. They're not paying really high dividend, they're not paying any dividend. So I don't really have any fear of missing out. Maybe I could sell cash secured puts, put spreads, something like that below the current price that it's at. What is it, about 1540? So maybe I do something like that. Overall, I really want to limit my risk. I think there could be potential for upside. Here, just kind of using multiples to get somewhat of a price target. Looking at $34 a share, which that could be high, right? I mean, it is high, but that could be abnormally high, right? Because the price is at $15.40. So if there's as much upside or nearly as much upside as I think, then this is definitely a trade worth making. So at that point, I'm just going to check option prices and see if it makes sense to buy calls, maybe long-term June 2023, maybe even go to January 2024, just to see. Because I don't want to go too short and then nothing happens, in like the next 3-6 months, right? So yeah, that one I think is interesting. Potentially a lot of risk, but potentially a lot of upside. So yeah, I like a limited risk approach, maybe just some calls. All right, so let's see. Take a look at the comments real quick. Loving streams, videos, very helpful. Oh, well, thank you. Hey now. Stellantis is Netherlands. Okay, I thought I read something that said they were France. Looking forward to Visa. But it's estimates based on who, what, hedges, apes. Estimates definitely not based on apes. They get them from Bloomberg. Well, I guess it could still be apes. So hedges, more so hedges. Are these companies that you recently? Yes, I have looked into them. Hence why I have a good amount of notes already. I think a stream would be way too long if I was just doing research live. But yeah, and as I mentioned earlier, check out the video that I posted specifically about my value investing style to kind of get a sense of my approach. Let's see. How new? Okay, yeah. So it's very new information. Yeah, I just looked into this like 2 days ago. Guessing $70 to $80 for oil for the next 1 to 2 years. Yeah, that's possible. I think oil and gas prices. Oh, is Google starting to work? I know it's starting to do something. I think oil and gas prices might go up for the winter, considering the energy crisis that's going on in Europe. But who knows? Who knows what it's going to be over the long term? Let's see. I did see another question. Oh, there it is. Yeah, CapEx. Yeah, I mean they're definitely increasing the size of the balance sheet, trying to make more money off this boom. So, again, I just want to make sure that they don't go too far. It's fine. You're making your money. You're gonna make a ton of money over the next 1 to 2 years. You're a small company. If oil prices, gas prices tank, you're going down. So I just don't want them to be too aggressive. Hopefully, I don't have to be in this play for too long. And some calls that'll make it a bit easier to stomach, right? Could you expand on why you prefer to look at those specific sections? Like, what is enterprise value and why it's significant to you? So I won't go into specifically what enterprise value is, but it is a standard across the industry to compare figures such as EBITDA and debt and free cash flow to. And it's just the real value of a company adjusting for cash and debt. So, because debt has value, right? So all it is, the calculation is just you take market cap and you subtract cash and you add back debt. So you can kind of see the calculation I have going on here. So I have market cap right there, less cash right here, add back debt. So it's a pretty simple calculation, but again, that's just the actual value of a company. And you could see that as kind of from the perspective of a company that would want to acquire another company. So that's mostly what it's used for. What's in the DFE tag? Oh, we know what's in the. Oh, you're talking about this. Oh, that's a secret. That's a secret sheet. Okay, so that was a lot to say about ESTE, about Earthstone. So let's move on. Let's see. Next, we got Visa. So actually, no, we're Stellantis. There we go. Next, we got Stellantis. Okay, so let's go right to their financials. So Stellantis, I'll kind of talk while we're looking at this. Stellantis is trying to make a big push into electric vehicles. They are a massive auto manufacturer. They're global, and they're a bit behind their main competitors. Tesla's obviously in the lead, right? But Volkswagen, I think, is a good second, pretty good second place, and Stellantis, we'll say, is behind Volkswagen. A little bit in terms of quality as well, in terms of range, battery power, stuff like that. So let's do a little bit of the same process that, and I'll go into some of those details in a bit, but let's do the same process we did for Earthstone. So revenue, we got some revenue growth, 22 estimates. Okay, that's good. Good enough, I'd say. 20 estimates for EBITDA. Is this in US? Let's go to US dollars because we're in America, or I am at least. So okay, 183 million or billion, in revenue, 26.4 billion in EBITDA. It's 14.5% EBITDA margins. Not bad for an auto manufacturer. Free cash flow, 7.8 billion expected in 2023. So I think even that's pretty good for an auto manufacturer. Okay, so we see growth across the board. Ooh, wait a second, EBITDA, not quite, but it's flat, so I forgive them. And free cash flow it's actually down. So I'm going to assume their sales are going up. So I'm going to assume this is all CapEx. This is all reinvestment, which I'm fine with. So let's go to financials. Okay, so spoiler alert, they did a big merger. They merged, I believe it was Peugeot and FCA, which stands for, you know what it stands for. So yeah, big merger between two auto manufacturers. That's the reason for the massive increase in revenue. So one thing I'm going to look for is some good synergies. That silly word. And I'm going to look at margins, right? So those margins have gone up. So that's really good after a merger. And again, I'm looking at operating margins right here. They went from 7.3, 8.5, 7.1, 10.6, 11.7. Fantastic. I'm sure some of that has to do with the car sales boom. But I think it's safe to assume that the company might be doing pretty well, aside from that. Okay, EBITDA $24.5 billion. Okay, so we do have an increase, I believe, in EBITDA either way. That's over the last 12 months. Okay. So yeah, I think it's safe to assume a little bit of a decrease in margins, considering that the auto shortage is not expected to last forever, which is particularly being driven by the semiconductor chip shortage, right? So, yeah, I think it's okay that their margins are expected to decrease a bit. They still have sales going up, so that's not too bad. Let's see. They do have R&D. So R&D, obviously that went up with the merger, so that's okay. Let's take a look at the balance sheet. Okay, lots of cash. Almost $50 billion in cash versus $191 billion on the balance sheet. Okay, current assets $83.3 billion, current liabilities $70.1 billion. Not bad for an auto manufacturer. A ton of that is cash. So, at some point investors, they want you to put that cash to work, right? I wouldn't want a company just to hang on to cash forever. Okay, shares outstanding, that recently changed because of the merger, so that's okay. We'll want to know what they're going to do going forward. The ticker is STLA, Stellantis. All right, so let's look at cash flow. Debt. $29.6 billion in debt. Okay, they have almost $50 billion in cash and less than $30 billion in debt. They have no net debt. They have far more cash than they do debt. So these guys are in a great position to further their push into the EV market. That's already started, but I think investors might want them to speed it up. Let's put it that way. Fiat Chrysler Association. Yes, you are the winner. Yeah, I forgot what it stood for, but that's okay. Because I'm looking at numbers here, right? Let's see. So cash from operations, $24 billion. Good free cash flow. Okay. We just subtract CapEx, right? Let's see. No preferred stock, it looks like. Fantastic. And they paid a special dividend. Maybe that was because of the merger. So that's nice. Very nice. So they do have dividends. They got a special dividend. Okay. What is that dividend? Let's look at valuation. It'll tell us. Forward dividend, 10.1%. That is outstanding, and they definitely have the cash to pay that. Let's go back to income statement, see what the payout ratio is. Payout ratio is 14.7% of the past 12 months. I am not worried about that dividend or about them being able to pay that dividend. This also might be assuming like a special dividend. So maybe it'll actually be a little bit lower. But still, what was the special dividend? Like 3%? That's incredibly high dividend. So that's nice. I really do like seeing something like that. I don't think they have an actual... Okay, yeah. So there's no history. It doesn't make sense to try to look at the trend in terms of valuation. So let's go back to estimates. Let's look at free cash flow. We got $7.8 billion expected for 2023. And let's go straight to the watch list. Okay, STLA is Google. Yeah, okay, Google's working for STLA. All right. So put in all the estimates per ticker, and we got a good number of estimates. I think like 20 at the low end. So I'm fine with that. put in all the estimates, and we're looking at a ridiculous 53% free cash flow yield. So this would be another reason for me to ask, what the hell is wrong with this company? Why are markets not valuing it better? So just based off of this and what I already know about the company, I think that they have a pretty distant third place position. They are making the push into electric vehicles, and they are actually increasing their market share in Europe versus Volkswagen, which is a very good sign. But maybe investors think they're moving too slowly. I think a lot of auto manufacturers are planning to, or at least a lot of the big ones, they're planning to go full EV or battery power by 2030, right? Which is a long time, but that's what most of them are saying. 100%, non-combustible fuel, whatever, by 2030. Stellantis, I believe they're saying they're going to be like 70%, 70 or 80%. So again, that's a very long-term prediction, right? And a lot could change. But the way I see it is, why don't you just say you're going to be 100%, by 2030, if that's where the whole industry is headed to, right? So I don't know. Maybe management wants to be conservative. Maybe they're just being realistic, and maybe they don't want people to freak out about the legacy business that they have, So let's take a look at some of the comments I have. Their other multiples look fantastic, by the way. All right. So primary risks, as far as I'm concerned, include strategy execution of their push into the EV market, and I think obviously there's a chance for a global recession, which should be on everybody's radar. Not saying it's guaranteed to happen, but it's kind of looking like we're going to have that. So company has very good liquidity. Their current assets versus current liabilities, all that cash that they have versus their debt. They have low leverage, so that should help the company speed up its push into the EV market. And perhaps if we have an actual recession and market prices, asset prices drop, Stellantis will be able to, they'll have some interesting acquisition opportunities to make, because they'll have all that freaking cash, $50 billion in cash, and past their debt, that's $20 billion excess cash. $20 billion excess cash for a company that has a market cap of $42 billion and not even $15 billion in enterprise value looking out to 2023. So, holy hell, they're gonna have plenty of cash to do whatever the hell they want to with if we hit a big recession, if asset prices drop. I think the key here is, I'm sure other investors too, I want to see them speed up their push into the EV market. Maybe they don't fully catch up to Volkswagen. I doubt they'll ever catch up to Tesla, right? Unless they, unless they made a partnership with Tesla, something like that. I was going to say acquire, but Tesla is like 100 times more valued higher than Stellantis, so that'll never happen. But I do want to see them make a bigger push into that. And based on off a few headlines, they have indicated that they're trying to push a bit faster. So I think, just right off the bat, potential catalyst. So the known catalyst is big push in the EV market, right? That's in the news, right? Markets don't seem to really care that much about it, though, right? Maybe their legacy business really brings them down. I don't know. I don't know what the markets are thinking about this company, because it's really undervalued, right? But potential catalyst that isn't being appreciated very much by the markets right now. They do make some interesting acquisitions, one or two, something like that, right? Maybe a battery manufacturer, and they improve their margins. They improve their production capacity, the speed at which they can produce cars. They continue to take market share from Volkswagen. Another thing, they continue to repurchase shares. So I noted that they previously had an agreement to repurchase up to 10% of outstanding shares through August 12th, 2023. I'm only including 1% per year in my assumptions, which is very, very conservative. But as you can see, with this yield, again, my hurdle rate is 5% for a company that's, let's say distressed, which I don't think Stellantis is. Maybe I'll look for 10%, maybe closer to 20% if I'm worried about a company, continue to exist, right? This is very, very high. So this share repurchase it's nice. I see it as a cherry on top, but I can increase this to, what do they buy back 10% of their shares, So that could go up in a big way. And by the way, that increases my price target by $2 from $31.10 to $33.10. So that's a big increase if they're able to really kick in the share repurchases. However, what I would like to see, rather than massive share repurchases, those are good, don't get me wrong, is a good acquisition, a very strategic acquisition that helps them catch up to Volkswagen a little bit faster, capture more market share. So let's just say that's a potential potential catalyst. I think they're hinting that they're going to do that. And the fact that they have so much cash on the balance sheet is kind of like, I'm just waiting for them to make that announcement, right? So to me, Stellantis, they do have risks. Again, those risks being the big obvious one is strategy execution. And then what if we hit a pretty bad recession, right? And global auto sales just drop. That's totally possible. Even though this company appears to be very undervalued by most metrics, if not all of them, the stock price is still going to react. Stock prices still react. If the markets are crashing, whatever was undervalued is going to become dirt cheap, right? So it could still happen. It doesn't mean, there's no way investors continue to sell this stock off. It could still happen, right? So there are still notable risks. However, I think this is one company that, out of all the companies I've looked at recently, I think there's room for a lot of upside if the company pushes forward more aggressively on their EV strategy. They have the capital to do it. I don't see why not. So if they do that, I'm basically in love with this stock. So this could be a very good cigar butt play if they, kind of fail over the long term, but they kind of succeed in the interim. A good example would be Best Buy of a cigar butt play, back, 5 years ago or something like that. So they really made a good comeback. And that was mostly due to management. Target, same thing, right? So yeah, I really like the stock. So I've picked up, or I plan to pick up some shares. I'm selling put spreads, and I'm looking at calls going out to 2024, because that could take a while. Maybe even 2024 isn't long enough, right? So I would like to see them be very aggressive in the next 6 to 12 months, right? But that is speculation. So all things considered, this is a long-term play. This is even going past my typical time horizon of 2 years. So I hope it goes up within 2 years. I hope they make some very good decisions, over the next year or so. And I think they have decent management. We'll see what happens. Overall, I don't think I think there's asymmetrical upside risk to downside. So I still want to be cautious just in case. There are always risks. But I'm feeling not too bad, especially considering that I'm being pretty conservative. We can drop these figures down a bit. Let's drop them down by a third, and that free cash flow yield is still 36%. So all this company has to do, if we drop their estimates down by a third, they just have to exist for 3 years, and I get my full that free cash flow yield just repays the entire enterprise value of the company in 3 years. That's insane. So, particularly for an auto manufacturer. So yeah, this is definitely one of the most compelling plays I've found in a while. So yeah, I'm gonna continue to watch this one, and I know good news is coming out. They're talking about making some partnerships and repurchasing more shares. So yeah, maybe the markets will start appreciating this one a little bit. So let's see. Has Stellantis CEO or board said they are pushing EVs? Yes. So they're already. I didn't make a note. I thought I did. Yeah, I thought I made a note here. I guess not. Well, I haven't memorized. So they are increasing their market share relative to Volkswagen. Volkswagen actually lost a bit of market share, I think, first half of this year. And some of that was gained by Stellantis. And so they're definitely pushing more towards EVs, towards the hybrids. They're big on the hybrids right now, but that EV push is definitely there. They have an interesting partnership with the battery manufacturer, which is totally going to help them. I hope they turn that into an acquisition. So the signs are there for sure. They have indicated on their earnings calls. They have discussed, shared it with shareholders. They're definitely going to push further into EV. The question isn't are they already doing it? The question is, are they going to speed it up because they have the capability to? Which is, to me, that's what would make this stock potentially a multi-bagger play. If they don't speed up that push, it's a good value stock. I think it's still a really good value, and maybe it does appreciate in price over time, assuming the global economy doesn't crash, right? So to me, I want them to be aggressive. I want that multi-bagger. Let's see. Be careful factoring in FCA, Fiat Chrysler is a marriage comparable to that of Joker and the Clown. So I think the way I see it, the way I prefer to look at valuation, look at financials, right? What happens if we take away Fiat and Chrysler? I don't know off the top of my head, but let's say, I don't know, what does that take away? 30 billion in revenue? Let's knock off 30 billion in revenue here, right? Oh, whoops. So let's say, and if you know, like how much of their sales are attributable to Fiat, just let me know. Or I guess I can just do it right here. I basically already did it. So if I apply this little multiplier, I cut everything by 30%, right? Revenue, EBITDA, EBIT, free cash flow. These are the multiples you're looking at. EV to EBITDA, 0.8. You can see up here, we got a lot of, this is low. Expedia, 5.7. Generac, 10.5. Google, 9 times. So here's Palo Alto, 26.4. So maybe some of these other manufacturing companies, maybe the oil and gas, right? Occidental, 3.8. So you look at these EV to EBITDA multiples, and it's painfully obvious to see how low Stellantis is trading at. So if you cut out all that, right? You cut out all the crap, right? Trim the fat on this company. Maybe they sell the part of their businesses off, the crappy businesses, and that's how they push into being more EV, right? EV focused. They just sell the gasoline powered cars, right? I don't know. Maybe there's a fat chance of them doing that, but the way I see it, trim the fat, take away whatever revenue, whatever cash flow they're getting from those companies. I know those Fiat Chryslers, they might be on the lower end in terms of margins versus their like hybrid cars, for example. So take it all out, and the valuation still looks amazing. Maybe investors wouldn't like that, if they got rid of that. So, yeah, that's kind of the way I look at it. It's, yes, maybe there's some crap, but even shit has a price. You know what I mean? So, and we could trim all that out. We could cut this. We could cut everything in half, and it's still looking like a ridiculously good valuation, So that's kind of the way I choose to look at it. And right now, I'm not loading up on shares. I'm not loading up on calls. I'm kind of nibbling because I want to see some more news. Maybe it starts to get some momentum. If we look at the stock price chart, this isn't a good trend, right? So we're just kind of coming down. It wasn't until recently, let's see, year to date still in a downtrend. 6 months, it could be argued we're still in a downtrend, maybe starting to break. And then the past 3 months, it's looking a little bit better, right? Surprisingly, what with everything that's going on in Europe, right? So, there's a lot of competition. The markets don't seem to be in love with this stock, that's for sure. So maybe I start nibbling at it. Maybe I pick up some calls. Maybe I get assigned some shares. But who knows? Maybe we do have a market crash, or maybe European stocks really, really drop through the winter, right? Then I'll get a better price. At some point, I will not be able to resist buying this stock, loading up. And at that point, I'll probably load up on shares. I'll load up on calls. And if it's that cheap, it's not even going to be that big of a position. So that's the way I see it. This one, if the interesting speculative catalysts come true, where they're very aggressive and they put a lot of that capital to work, then we probably have a multi-bagger on our hands. If not, it's just a classic value player. Either way, if it's going to make a lot of money, I only need a little bit of the stock. And if I'm wrong, I only want a little bit. So that one's looking pretty solid. I think that's all I want to talk about Stellantis. I think it's mostly kind of valuation, big upside, big downside risk considered. So I think we've kind of covered those. The legacy businesses, yeah, we can go on about those. There's high competition with EV. I think a lot of that stuff's kind of already known. So yeah, I just want to look at numbers and see, okay, what's the max pain point for this company? Because if we're not close to it right now, I don't know what it is, So this company's not going anywhere, not anytime soon, that's for sure. Let's see, what percentage of my portfolio is in, we'll call it STLA. STLA right now, I'm starting out very small. I think it's just, I want to say 0.5%. And well, I've kind of already seen all this. Basically, every news story that I see that I think is a good reason to, for markets to appreciate it more, I'm probably going to increase position. I'll probably double it, add another 0.5%. I think I didn't hesitate to initiate that position because they said they're repurchasing their shares from GM. And I think that was something like 10% of their outstanding shares. So that I was like, okay, like let's do this. I'm only assuming 1% share repurchases over the next year and a quarter, so already they're like, we're going to buy 10% back. So that I was like, okay, 0.5%. If I keep seeing more big news like that, and that is a pretty big event, right? I wouldn't hesitate to add another 0.5%, and this stock is pretty undervalued, very undervalued the way I see it. So even if it moves up in the meantime, say it moves up to, it's at 1356, say it moves up to 16, it's still undervalued. If I put this at 16, 35% free cash flow yield. Oh, whoops, let me try to leave that up. Yeah, 35%, So at what point does it suck? 22% free cash flow yield if it goes up to 20. So I don't mind adding more if it looks like they're executing on their strategy and the markets start to appreciate it, a little bit more. This downtrend on the chart kind of it starts to really turn into a nice uptrend. So you can kind of see that over the past, over the past few months, right? It looks like it's trying to. Maybe it's just the markets overall, but I don't mind waiting for some confirmation, even if that means I have to pay a couple extra dollars for the share price. It's still really undervalued. So yeah, I'll increase my position size as I get more confirmation that the company's on track in terms of their executing their strategy. All right, so January 2024, $20 calls look juiced at the moment for STLA. Juiced indeed. I might go for June, or actually January. I don't even know if they have June yet, but yeah, I think I did get January calls. I'm pretty sure I got 20 actually. Full disclosure. Appreciate the analysis, Stellantis. I understand the auto business, so it's definitely a stock I'd be interested in owning at the right price. Yeah, exactly. So even those short puts, I'm sure they're selling for a decent premium, So maybe it's not $13.50. Maybe you want to sell puts at $12, $12.50, something like that, and just subtract the premium, and that's your entry price, right? So pretty good. How you feeling about selling October 13 puts for 3%? 3%. Yeah. I like a little bit higher than annualized yield of 3%. Did you make that Excel spreadsheet? I did, and I've spent years trying to improve it and adding to it, and it's been a pain in my ass. And I do want to automate all this crap because I'm just going to show you real quick my whole, let's just put holds. So this isn't even all the stocks that I have. So I have, at least a couple hundred. I've probably analyzed in total, I don't know, at least 500 companies over the past 9 months. So I do want to automate everything you see in blue font. That's manual inputs. So I do want to automate a lot of that. And if you noticed, I've done inputs for all those freaking stocks. So, and then for my short watch list, my financials, yes. So I made the spreadsheets myself. And I'll go into the spreadsheet a little bit more in the next video I do on my screening process and the sources I use. Let's see. Yes. Yeah, it is a pain in the ass. But yeah, I like it. It serves a good purpose for me. Okay, so that's STLA. Let's look at the next company, which has a very nice 10K. This 10K is quite lovely, if I do say so myself. I don't typically just peruse 10Ks. That's not how I get my kicks. But Visa's 10K it's pretty nice. It's got some color. People like color. So, it's pretty specific. It's a good 10K. I've seen a lot of 10Ks, and this, sir, is a good 10K. But anyways, Visa. Let's go straight to the watches. So Visa, I don't think I have to do nearly as deep of a dive on Visa. I know what the company is. I know what they do. I know how they make money. I know that they've been a very strong company over the long term. We can kind of verify that by looking at their operating margins, for example. Let's just look at financials over the long term. Top here, we have revenue growth. The poop-colored brown bars are revenue, and you could just see that growing like crazy year over year, right? So one thing I found very, very interesting, and I'm sure it was because of a good acquisition, they increased revenue from 2006 to 2010 by, 2.5 times? So that's incredible to me. Through the Great Recession, each year, revenue kept going up. That's ridiculous. So I don't know how they did that. I'm going to be honest. They must have made an acquisition, right? Or they just really took off as a business, right? So to me, this screams very good management. They continue to grow revenue. I guess they had one down year in 2020. Maybe a big shift in sales mix, right? Maybe it just didn't strike them well. But I'm willing to assume that their margins went up. Are these margins right here? Okay, operating income. Okay, operating income looked a little bit down. Net income a little bit down. So I guess we'll look at free cash flow to find out. But speaking of operating income, back since 2009, maybe they changed their accounting. I'm going to assume they changed their accounting up until that point. So since 2009, they have had over 50% operating margins every single year. That is wrong. I was about to say outstanding. They had over 20.5% operating margin in 2012. Okay, so let's consider that an outlier. I almost didn't catch that, but that's okay. We'll consider it an outlier. Over 50% every other year. We have years where it's over 60%. Now it's 65.6%. This is ridiculous. This is a very, very nice trend. Even if they had another year where it dipped to 20% or something, I would say this trend is freaking awesome. So they're looking very nice in terms of long-term trends and financials. Let's drop down and look at free cash flow. 505 back in 2007. Nice dip in 2008. No problem. A massive jump to 2.5, close to 2.5 billion in 2010. Holy hell. So that's a 400% increase about. And then it just skyrocketed from there. So this free cash flow, 2020, bit of a dip. But yeah, look at that. Let's see, past 2021, so go from 2012, or I guess 2011, 3.5 billion in free cash flow, 14.5 billion now. That's crazy. So I don't think there are too many questions for Visa's financials, but we can still take a glance at them. I won't go as in depth, but honestly, if you're questioning Visa at any point, never mind value, right? We haven't gotten to value and price, but if you're questioning their financials, I think you need to watch some of those those YouTube videos that have the crazy thumbnails, right? Stocks on fire, or whatever, and you got to know financials, yeah. I don't think there's a good reason to question Visa's fundamentals, their financials at this point. It's all about what's going to happen going forward, how they're going to do during any type of economy, right? And then obviously, biggest question is, what's the price? What are we going to pay for? All right. So through 2020, good reversion back to very strong free cash flow, and then that's still been increasing. Increased 7%. Fiscal year ending September, so ending this month. So we could pretty much lock that in. I doubt it's going to be much different than that, right? So we'll assume 7% increase. That's a slightly conservative. I think that's 7.3. So we'll assume 7% increase year over year, And the next year, they're expecting almost a 19% increase in free cash flow. Visa just doesn't give a shit, man. So revenue up 11.5% for next year. EBITDA up almost 14%. Estimates looking great. 30 estimates for revenue, 22 for EBITDA. Only 6 for free cash flow. That's surprising. But then again, I think because of how they make money, you can kind of see EBITDA as a proxy for free cash flow. And it does look very close. You look at all the years, especially these recent years, 20.2 billion, almost 16 billion, 23 billion, 18.5 billion. Okay, so it's not too far off. So I think it's safe to assume, let's just take advantage of the fact that they have very predictive trends, very consistent. And we're gonna assume that free cash flow is indeed gonna be at least, we'll say, close to 18 billion versus 18.5. So I think it's an okay assumption. So let's look at, let's just go straight to the watch list because we still gotta cover Nintendo. All right, so got all the financials here. Actually, let's check one thing real quick. Let's go to the balance sheet. Now, I want to look at outstanding shares. Year over year, outstanding shares have decreased. I wanted to make sure I check first. Okay, so decrease in shares outstanding each year. So they're always repurchasing shares. Let's take a quick glance at the stock price. 5 years. That thing's looking nice. Good dip in COVID. Went from 211 to 150. Man, that was a good dip. That was a good buying opportunity. You got anywhere around maybe 170, even 180, So good. Peaked at 248.50. Now trading at 195. Okay. So the markets don't seem to, it's been choppy so far this year, but so have the markets. Based on this chart, I would say that the markets don't seem to go crazy for this stock. Let's look at the 3-year. Okay, it's not that bad. They don't seem to get too hyped on this stock. They don't seem to panic too much on this stock. So that's kind of what I'm getting, just from a broad, high-level technical analysis standpoint. And if in case you haven't seen the video, I talk about my style. I do look at technical analysis, but at a very high level, and I look at the long-term daily chart. So that's how I prefer to keep it. And based on this, the markets, sure, it's been choppy over the past year, but the markets don't seem to panic too much about this stock. So I would assume that this trades in a pretty tight trading range. So let's look at valuation and kind of confirm that. Let's go back to, let me hide this. There we go. So we can see more. Enterprise value to EBITDA. That's what I'm going to use for Visa. So I see a low. I'm looking right here, right above this, the highlighted part, the highlighted row. So I see a low of 18.4, looks like. So not even through COVID did it get that low. Very interesting. So I see it low of 18.4 back in 2017. High of 30.1 end of 2020. So based on that range, this is over the past 5 years, we're almost at the low. So that's pretty nice. If I had to guess and say Visa's never going to become way overvalued, right? And they're never going to become very undervalued. I can still look at this and say, you know what? They are trading at the low end of their enterprise value to EBITDA multiple range. And if let's pull out that 30 times. Let's say 30 times is an outlier. And let's say, we got 28.6, 28, 27. Let's say 27. Let's just rule out the 28s. Let's say 27 was a high. Let's try to be a little more conservative. We can go even stricter than that. Let's just bring it down to 24.5. 24.5 is the high, right? It's still at a very low end of that range, 18.4 to 24.5, because I could do the same thing in the other end, right? I can assume that these low multiples are kind of outliers, but I won't. Let's just be very conservative. That's a low end of the trading range, which the markets don't seem to want to deviate too far from, right? Just based on a lot of other stocks that I've looked at. All right, free cash flow yield, 4.5% over the past year. So let's look for a high. Over the past 5 years, 4.5% is the high. What's the low end? Right, so this is basically inverse, right? So I want to look at the high end versus the low. Compared to EV to EBITDA, I want to look at the low end versus the high, right? So they are at a 5-year high. And the low is 2.5%. What was that, COVID? Yeah, 2020. That's incredible. So that's, I mean, for Visa, I'm not looking at the stock and thinking, oh my God, it's going to be a multi-bagger. It's buy calls, everything, all the shares. It's not like that. It's Visa, right? I don't think they're going to suddenly go to massive growth and it's going to be an easy 5 times multi-bagger. I don't think that's the case, right? But so far, I'm seeing that markets are trading it at the low end of the range. Maybe they're worried about recession. Maybe they're worried about Visa's business just not doing so well, right? Speaking of which, before we jump back to the watch list, my spreadsheets, let's take a look at how they make money. So I looked that up beforehand, and it looks like, compared to their peers, MasterCard, Discover, and American Express, Visa charges the lowest rate. So I guess if we're looking overall, American Express just charged lower. Maybe that's at the low end. I assume that any of these companies are going to charge a higher percentage transaction fee, the lower the sales amount, right? That's just logic. And Visa. Okay, Visa's just up there at the high, right, with MasterCard. That's okay. We'll come back to that. 1.29% at the high end, which I'm assuming this is for like high sales dollar amounts, right? So overall, they look very competitive from this standpoint. This 3.29%. So this is high, but I guess it's not too much of a difference. American Express does have, they do have an edge there. But I do know most companies do already accept Visa. Some of them even prefer Visa, right? Like Costco. And I guess I can see why. Because Costco, people are probably buying in bulk, or I'm sure they are. So, they don't have to pay Visa as much compared to these other companies. So I think at the low end, I don't think this is that big of a deal. The fact that they're a little bit higher. The reason is because I'm assuming there are switching costs, right? And overall, I don't think businesses want to sell small dollar volumes, period, right? I think every company wants their dollar transactions to be somewhat high, right? Sure, there are some that are just, hey, just spend $1 here and there, right? Maybe Dollar Tree, for example. But if we hit a recession and we hit a good economic downturn, and people start to shift spending to lower value items, cheaper items, this percentage will net Visa a little bit higher than Discover and American Express. So I see it as kind of a bit of a buffer, assuming that they can maintain their their merchant loyalty. So, and I think so far, I don't think anyone's really, maybe they're already with Visa and they say, if I increase sales, I don't want to go to American Express because that's the gambit I run, right? As I increase sales, I'm going to have to pay a higher percent, right? So I'm going to see this as, I think this is okay. I think at the high end, they're obviously the best, and maybe that's what we want, right? So overall, I don't see a big issue here. The thing that I do notice is is that if we hit a downturn, the high dollar items are going down, right? But Visa charges more for the lower priced items versus, MasterCard, Discover, and American Express. So maybe it's not that big of a deal to them. Surely their dollar, earnings, surely that's going to drop a bit, right? It's going to drop for all these companies, right? But the way I see it is they still charge that little 5-cent, 10-cent transaction fee, the processing fee. So there is some buffer. And if people spend less money on value goods, but they're still making those transactions, then there's a bit of a buffer. So I see some resilience to an economic downturn. I won't say recession-proof. I'll never say that about any stock. but I do see some resilience for Visa. I'm sure these other companies have, a bit of resilience as well. But just in general, I think that the business model they have, assuming there is a shift in consumer spending, I see a bit of resilience. So probably not the end of the world if we do hit a pretty good recession. So that's something I want to note for how they make money. But yeah, so I won't go into too much detail past that. So let's go back to the watch list. Let's check out the value. So there are the estimates. I do include an assumption of 0.5% share buybacks through 2023. That is slightly conservative. I think it's typically a bit above that. But considering that the share price is, I think it's fair to say that, let's see, what's 6 months. It's kind of low. If management has a good amount of cash, which let's double check, through 2023, they'll have more cash than debt. Okay, no problem. Buy back all the shares you want at this price. I don't think you're overpaying. That's fine. Go for it. So if that happens, maybe they increase share buybacks. That'll be nice. And I believe they give a small dividend. It's nothing to write home about, but yeah, 0.77%. That's okay. So they definitely have cash. So I got a bit of a share buyback in my assumption. Free cash flow use 4.7%. That doesn't actually meet my hurdle rate of 5%. However, I am noting a bit of resilience on Visa's part and to, some crazy activity in the economy. And I'm also noting that they're trading at a very low end of their trading range based on the past 5 years. And sure, we can, I did discount some of those very high figures, right? We had a tremendous bull run. So I'm just going to count. I'm going to rule out the really high numbers. That's what I did with enterprise value EBITDA. We looked at 24.5, ruled out everything higher all the way up to 30, right? So 30 times EV to EBITDA, that is. So I think it's safe to say that Visa is trading close to a low. However, these other multiples, I think they look okay. Debt to EBITDA is nice and low. It's under 1 times. So they got a lot of cash. I'm not worried about this company. So if it isn't, say, the most undervalued company that I've looked at, I think it is trading at a decent discount. And I think there's probably a very strong bullish case that can be made for buying the stock even at this price. But let's say I'm greedy and I don't know, I'm a doomsday person and the stock market's going to crash in 33 days, right? So let's say I just want to get a really good price. What do I have to buy the stock at get at least 20% upside? So here's my little upside right here in this column. This isn't law, by the way, for me. This is just a reference, if you will. So if I buy the stock at 175, I'm getting 21% upside based on my valuation. That's not bad, and I'm even conservative with that. So basically, I'm always going to be conservative across the board. So I think if I was just a typical value investor, and I wanted more safety, I'm worried about the economy, I want very good long-term companies. I have a time horizon of longer than 2 years, right? Look at 5 years, 10 years. I'm looking to retire off the stock. I think Visa is a damn good buy at this price. If I was looking for a multi-bagger, I'd probably say, maybe I load up on some calls if we have a market crash. That's the way I see it. I don't think it's overvalued, not by any means, right? There's some obvious risks, but I like to look for the multi-baggers. So Visa, I have made a play on it. It is limited to options because I am kind of worried about potential drops in market prices overall. So I'm just kind of limiting the capital that I'm putting to work either way. But I think if you're a very long-term investor, Visa is definitely a stock that should be on your watch list. Yeah, for sure. So let's see. Let me just take a gander at the comments here. Oh, yeah. So this spreadsheet is, everything's on Google Sheets. Some input from DFV. Honestly, not too much as far as the spreadsheet goes, but I will say, like, I did get a good amount of influence from DFV. For example, that's why I like to focus on multi-baggers. But I am a bit of a hybrid, I would say. I do like trade volatility. I don't mind getting into stocks like Visa, even if they're not a multi-bagger, So sort of barbell approach where, a little bit of relative safety on one end, and then I take a good amount of risk on the other end. Visa, I would say, is pretty safe. Best janitor ever, thank you. I don't have style, I got swerve. Okay. Everybody seems very convinced on Visa. There are no questions. But yeah, and again, I don't see this as a big multi-bagger. I'm not going to strike it rich over the next 1 to 2 years. This isn't a GameStop, right? But I'm sure if you check YouTube, if you check other streamers you might follow, there are probably people pounding the table on Visa right now, if I had to guess. So probably more excited about it than I am. But yeah, I think it's a good stock. It's a good company. All right, so last but definitely not least, Nintendo. So a few tidbits, few bits of news about Nintendo. For those who aren't video game buffs or big Nintendo fans, I like Nintendo, but I'm not, like diehard Nintendo video game fan. I do like their games, sure. But for those who aren't, they are coming out with a good amount of basically blockbuster hits, if not so in the US, very much so in Japan. So like Zelda, I think most people have heard of Zelda. That game's actually coming out next year. Fire Emblem is one of the best-selling games like of all time in Japan. So I don't know how popular it is in the US, but looking at previously looking at figures for Fire Emblem sales, Japan loves this freaking game. They go freaking nuts over Fire Emblem. So it's no surprise that they're releasing Fire Emblem games like once a quarter or something like that at this point. Xenoblade Chronicles 3, I think it's already out. Yeah, so I think this is already out. This game did really well in Japan as well. I don't know what this game is. I'll skip over it. Splatoon 3. I really don't know anything about this game. I think they're like squids, right? This game is a smash hit in Japan, and I think they're on track to breaking records for release date sales, something like that. So Nintendo stock on the Nikkei, on the Japanese stock exchange, it was up like 5% when they mentioned their sales figures on the release day. So yeah, this game's obviously a big deal. So overall, they got a pretty good lineup of video games. They're expanding their online subscription. They're adding GoldenEye for you old school people out there. Pokemon Stadium, I remember playing that when I was a kid. I was in love with that game. So yeah, they're adding a good amount of games, old school games, to their online subscription. And they're coming out with just a lot more games. Nintendo Sports is, believe it or not, that's one of the highest grossing video games of all time. That I guess that series. So I thought that was interesting. Another Pikmin game that seemed to do pretty well. So yeah, just a whole bunch of games, a lot of blockbuster games coming out this year and into next year as well. So a lot of big news for Nintendo. They are shifting their sales mix a bit towards the software side, and I don't mind that because hardware sales are in question, understandably so. So yeah, a lot of good news coming out from Nintendo recently. They're also working on the Super Mario movie, which is going to come out, I think, mid next year, I believe. And another thing they're working on is Super Nintendo World. So if we go to the website here, so for those that don't know, Super Nintendo World is already live in Japan. I believe it's in Osaka, Japan. And apparently it's doing very well. And they have their scroll like this. Okay. They have the first Super Nintendo World opening in the US in, I believe it's Los Angeles. I believe it's LA. I think that's spring. It might be spring of next year. So I don't even know what's going on here. I guess just taking a virtual tour. Uh, so yeah, that's opening up. I believe it's next spring, and then they have another one coming up in Orlando, Florida. So already they have 2 Super Nintendo Worlds planned for the U.S. So I think it's a pretty big deal. I don't know what the sales look like yet for each theme park, but I do like that they're moving into this space because as I've mentioned before on a certain very popular subreddit that I may or may not be a mod of. Super Nintendo World, I think, is that in the movies. They're trying to turn this company into like a little Disney of Japan. And I think that's awesome because when Disney first started really growing out their business and doing, Disney World, stuff like that all over the world, investors are going crazy for Disney. And, that company now, I've talked to so many people that are like, oh, you buy Disney on any dip, like Disney, you don't fight the mouse, right? So I love that Nintendo is doing this with this company. So I think historically, the way Nintendo has been viewed, which I think is justifiable, is as kind of a slow mover. I think during COVID, they generated a ton of sales, and I hope Nintendo's fine with me having this on screen. I'm just gonna assume they are. I'm a big fan of Shigeru Miyamoto. Okay, yeah, don't get mad at me for doing this. Don't sue me. So so yeah, during COVID, they had incredible sales, like a big increase in sales for consoles, and particularly the game Animal Crossing. And let's see if we can see that here. Let's see, NTDOY is the one I want. Maybe. Is this the one I want? I'm trying to bring this up. Okay, that's fine. Okay, so this will be. I'll just keep it in yen because otherwise it looks real wonky because of the foreign exchange rate. So in 2021, their fiscal year ends March. By the way, so relevant year is ending March 31st, 2021. 34% increase in revenue, which was ridiculous. Like that was astronomical for Nintendo. The margins were really high. Big software sales, big sales of the Nintendo Switch console. So going forward, they were basically destined to have a drop, right? So coming off the console cycle, sales are going to drop. So writing was on the wall for that, right? And then if we look at the stock price over the past 3 years, you can tell by looking at the stock price. Big increase, specifically through COVID, low of about $301 on, I think, is this? Okay, so this is the regular stock. So about $301 during COVID, that was the low. Hit a peak of, what is that? 651. So more than doubled through that time period. And this is Nintendo. Nintendo's not used to doubling in stock price over a time period like that. When the Switch came out, that did kind of happen, but typically it's, it happens when a new console comes out and it does really well. It doesn't happen again, so for the same console. But that's definitely what happened for Nintendo. Coming off a very hot year. Oh, the markets are closed now. No biggie. But coming off a hot year, their sales were destined to drop, right? And the stock price chart kind of reflects that. So if we look at the long term, we look back at, let's say, 2000 fiscal year ending March 2020, 1.3 trillion yen in sales, even with this decline over the recent fiscal year and this past 12 months. And I think they're expecting another decline for the upcoming fiscal year. You still had revenue growth from 2020. So that's pretty strong. And coming off the really strong years they had from the Nintendo Switch release, they're doing pretty damn well for a company that hasn't released a new console in a while. I mean, sure, they have they have some peripherals and they have the different like Switch models that they've come out with. But this is post like Game Boy, Nintendo DS, all that stuff, right? It's just the Switch now. So I think they're doing very well, all things considered. And overall, what I think happened over the course of the past 3 years is the company, specifically the investors, got a taste of what high growth
is like, even though you don't have another console coming out. So now they're shifting their sales mix. They're trying to shift more towards software. So that's why they're kind of pushing out the subscription model more. But on the other hand, they're also pushing forward with movies and cinema and the theme parks. So let's just take a glance. We could look at estimates, but I think it's going to be all over the place. Okay, so that's whatever. In terms of yen, they have a 20% increase in revenue expected for fiscal year ending March 2023. So that's actually pretty crazy. It's probably not going to look like that in US dollars, but that's okay. I just want to see how the company's doing. These figures are going to change. They're going to be all over the place if we look at US dollars. So free cash flow down a bit this current fiscal year, but right back up. It's still looking good for fiscal year ending March 2024. So let's look at the financials a bit. So we looked at revenue, EBITDA. It's going to look crazy in yen. How about we look at their long term? I wonder if this will show me, because it might hide it. NTDOY. Might have to look at the F. Okay. I don't pay them. I just take what they offer. Okay, that's okay. We don't have to look at long term right now. But I can look at the operating margins for the past 5 years. This kind of had a low back in March, fiscal year ending March 2018. And I assume that was coming off the console cycle where software sales are kind of dying out. Maybe hardware sales are kind of dying out. But hardware, the consoles had a lower margin than software. So you can kind of see over time, you can notice that shift from hardware to software because that operating margin has gone from 17%. Now it's 34%. That might still be considered high. Maybe we go back down to around 25%, going forward. But that's still much better than what it was previously, even 2019, 21%, right? So I'm thinking, that mix, that shift that they're incorporating into their sales mix, I think it's a very smart one. Let's look at the balance sheet. So 2 trillion yen. I just get a chuckle every time I see that 2 trillion amount. 2 trillion in current assets versus 491 billion in current liabilities. It's over four times the current liabilities they have in current assets. Cash, 1.5 trillion versus no debt. They have no freaking debt. This is ridiculous how they're able to have all this growth over the long term, increase efficiency, increase their margins, and not have any debt. This is outstanding to me, and this is why Nintendo is my biggest position. It's the biggest position in my portfolio. And I've bought these recent dips. So far, I haven't even finished the analysis, but as you can see, they have zero debt, no leverage problems. They have very high liquidity, looking at the current assets less the current liabilities. They've grown revenue. They've increased their margins. And I know that there are a lot of criticisms of Nintendo, the slow movers, stuff like that. I think it's evident that they're shifting that, right? And they're trying to grow a little bit faster. Another side note is that there's been increased interest from private equity into Japanese markets, capital markets, and stocks too. So I think, and there are a few podcasts that I think you could listen to. Maybe Thoughts on the Market from Morgan Stanley. I think they touch on that, and maybe UBS. Can't remember UBS the title of the podcast, but yeah, if you just look up UBS and podcasts, you'll find them. And if somebody wants to remind me, I'll throw them in the links as well, or in the description of the video. So I think there's reason to believe that the catalyst for Nintendo is not fully appreciated. And I think, honestly, the markets aren't really expecting another big catalyst. They're not expecting another console anytime soon. They're not expecting another COVID year, right? Who knows how much money they'll make from the theme parks at this point. I don't know what those sales figures look like. I do know that the traffic is good. And once they fully open up in the U.S., particularly the one that's coming in LA in the spring, that might be a good time. Maybe the Fed starts easing, right? Liquidity for the market starts increasing liquidity. Who the hell knows, right? But I think that might be a pretty good time to open up some theme parks in the U.S. And maybe that with the new movies coming out, they're pushing back into cinema and TV shows. I think it's looking pretty good. They're looking like a little Disney. I say a little Disney, but I think they have more cash than Disney. So yeah, maybe I'm optimistic, but I think there's good reason to be optimistic. So to me, so far, this is looking like a great value stock. Like I said, it's my biggest position, and we haven't even finished this analysis, right? They are repurchasing stock, so that's a great thing. 95 billion yen spent over the past, or I guess fiscal year ending March 2022. Let's see what that is in dollars. 783 million. So that's pretty good. At least they're putting that cash to use. What's cash in dollars? 11.5 billion. Okay, so they got plenty of cash to spend on stock repurchases, and they have indicated that they're going to continue to do that. Speaking of shareholder returns, they do have a nice dividend yield. I think they go for about 30 to 40% of net income. Forward dividend yield. Oh, it doesn't have it here. Let's just look it up real quick. DOY. 3.7%. Not bad. And that's going to fluctuate. That's going to be based on earnings, right? So I think in my estimates, which again, I don't really look at dividend and say, okay, I will get this dividend, therefore the stock is a buy, right? But I'm assuming that they give about 3% in dividend. So I'm dropping that figure a good amount. So they definitely have the cash to pay that dividend. It's no problem. Plus, again, it's a percentage of earnings. Forward free cash flow yield per this is 4.9%. But I'm looking at 2023. So we got 353 billion yen free cash flow. And overview, 5.7 trillion yen enterprise value up here. So that's about 7.5%, I want to say. Just doing math off the top of my head. So that's looking pretty good. 7.5%, I'll take it. That's a nice free cash flow yield for a beast of a stock like Nintendo, which is a literal money printing machine. Let me scroll this a bit so we can see everything. Okay. Let's look at the trading range. I'm going to look at enterprise value to EBITDA and free cash flow yield. I'm going to focus on those. I'm not sure that enterprise value to sales, I don't know that the markets care too much about that. I'm looking at a stock like Nintendo. I think it's mostly for growth stocks, which Nintendo should grow. They're still growing over the long term, but I don't think the markets look at them like a growth stock. So enterprise value EBITDA, we have a high back here of 18.6. We're at 9.65. Low of, not even through COVID, low of 8.34. So we're definitely at the low end of that range. We can even rule out that 18. We can rule out the 16 back here. Let's rule those out as outliers, just to be conservative. Then we got a high of 12. So we're still at a low end. We're still moderately low if we're trying to be very conservative. So far, definitely at the low end of the trading range, right? Markets, I guess, aren't expecting much from Nintendo. I don't know why, because they basically announced everything that they're going to do, right? And they keep releasing all this news, and investors just don't give a shit about Nintendo. Okay, that's fine. Gives me a good buy price. I can wait. Levered free cash flow. I see a high of 6.7%. So that's pretty high. Low of 2.4. Is that right? Okay, so we're mid-range. Slightly high. So that's okay. And I think I have a 2023 free cash flow yield of 7.5%. And by the way, I think this is over market cap. I go for enterprise value. Okay, so yeah. If we make that adjustment, 5.7 trillion enterprise value versus close to 7.3 trillion market cap. if we look at that valuation and say, look at this 4.9% free cash flow yield, that's going to be closer to 7%, 7.5%. So yeah, basically multiply each of these by about 1.5 times, right? So that's pretty damn high free cash flow yield. So let's look at my spreadsheet here, and then we'll kind of call it a day after this. Okay, so put those estimates in. It's wonky because I'm using US dollars. I do assume 2% in, or 2% reduction in total shares outstanding by share buybacks, which I think is conservative. These numbers are going to be all over the place, but point is, I want to see what their valuation looks like, with some reasonable estimates, right? So we still got a nice 7.3% free cash flow yield. Dividend payout ratio goes up to 73%, so they'll probably drop it down. So that's why I'm assuming that it's going to go down closer to 3%. But 3% is still pretty solid. Debt to EBITDA, there is no debt, so that's fine. Enterprise value EBITDA, what did we say the low was? I think it was 8.34? 8.34 times historical low, right? Forward, 6.4 times. This value is dropping. It's plummeting. So to me, the markets are not valuing this based on forward expectations. To me, they're looking at these estimates and saying, there's no way. Like, cut these by a third, and maybe that's what you're going to get. And there's a 5% free cash flow yield. There's a 9.5 times EV to EBITDA. So I think the markets think that Nintendo is just not going to cut it. So based on what Nintendo tends to communicate, and they do this kind of weird, I think they'll probably change this at some point as well. But the way they've done it in the past is they're very conservative on their estimates, right? And they typically beat their estimates. I don't think they're conservative because they're pulling that trick that a lot of companies try to do, the growth companies, where they say, oh, we're definitely not going to grow more than 20%, right? And then their estimates or their results are 30% growth. And they just keep doing that, right? They know they're going to grow faster than the estimates that they're stating, right? Than their guidance. I don't think that's Nintendo's actual plan. I think it's just Japanese business culture to be extremely conservative, right? So they're always very conservative on their guidance. Another weird thing that they do that I hope they kind of change is they don't say everything they're going to do. So they don't say that they're releasing a new console until, like 6 months before, right? Where all the other, big video game companies, Sony, Microsoft, you're going to know like 2 years in advance, right? So Nintendo kind of sneaks information on you. I hope that kind of changes because it kind of makes them mysterious, right? So it's kind of hard to predict what they're going to do. And I think it is kind of changing. I don't think they can say, oh, surprise, we're coming out in a movie in 3 months, right? Surprise, theme park's coming out in 2 weeks, right? I don't think they're gonna stick to that for the most part. So maybe for their blockbuster video games, but even that, they've been talking about the new Zelda game, which is one of their highest grossing video games of all time. They've been talking about that for at least a year now. So, and that's not coming out till middle of next year, May, I think. So overall, I think the perspective of Nintendo, they're a slow mover. They don't say much. They only make money when there's a new console and there's no new console coming out. Maybe it's not going to come out for another year. I don't know. But maybe they're not going to say it until it's like 6 months out because they don't want to cannibalize Nintendo Switch sales. I think that would be the smart thing to do, to be honest. But let's just assume a new console isn't going to come out for at least another year or two, right? But that's fine because they're shifting more towards software. They have all the capital in the world, all that freaking cash, no debt, to continue to add theme parks, to make more movies, more shows, whatever the hell they want to do. Plus, by the way, they own at least 33% of the Pokemon company. I say at least because they actually, go figure, they're not public about how much ownership they actually have in the Pokemon company. It's speculated that it could be up to 50%. To the extent that they don't have majority ownership, right? So who knows? It's either 33%, somewhere between 33% and 49%, right? But main point there is they have significant ownership of Pokemon, the world's most successful, by far the most successful franchise in history, right? So they're going to leverage that. They're going to keep making shows, movies, merchandise. The Pokemon company is going to keep doing what they're doing, and Nintendo's going to keep getting 33% of of those sales, right? So I think everything looks really, really good, and they're coming out with the new Pokemon game too. So that's really, really good. I'm assuming even if it's 33%, they're probably making more money on their Pokemon games than any other game that they produce internally. So that's how powerful of a franchise Pokemon is. So I think there are a lot of reasons to be bullish. I think if you didn't expect a catalyst, Nintendo's trading at a good value. Multi-bagger, I don't know about that. Long term, though, if they continue to execute on this growth strategy, this new, I would call it new and improved growth strategy, theme park, cinema, more towards software, and maybe, I don't know, the market start paying attention to Nintendo a bit more. The volume kind of sucks. I'll admit that, right? But if all these things kind of start to happen over time, yeah, maybe it is a multi-bagger over the long term. Unfortunately, there aren't any options, though. So I am loaded up on shares. Maybe I'll buy more if the stock price dips some more. But as it looks right now, I have no problem with this being my biggest position. It's a fantastic company. The company has weathered some big storms. Everybody talks about Activision and EA, right? But their valuation isn't even close to Nintendo. It's amazing to me that, like, why doesn't Microsoft say, you know what, screw Activision, your market cap's $51 billion, we'll give you $75 billion for the whole company, Like, why the hell not? Give them a 50% premium. Knowing Nintendo, they would say, hell no, nobody's buying our company, right? But it's just amazing to me that everybody wants to look at other video game companies just because the stock price hasn't moved, So I don't just look at companies based on stock price movement. I want to see what their actual value is, what their valuation, right? So to me, it's easy to ignore all the other big video game companies and look at Nintendo. A lot of reasons for this company to continue to do really well. And inevitably, they're going to announce the next console. Whenever that is, I'm sure the markets are going to start paying attention to Nintendo's stock price again. Because Nintendo, sure, they've released a few bad consoles, but I think they've got it together pretty well now, and they're starting to pay more attention to their investors. They even did a stock split of the shares traded on the Nikkei. So yeah, even little stuff like that is telling me that they're paying attention to their investors more. So yeah, a lot of good signs for Nintendo. I think they're pretty good. I wish they had calls because I'd be buying leaps for damn sure, especially at this price. But yeah, all things considered, this company's not going anywhere, and they're trading at a good value. Yeah, this is if you don't like it for it doesn't have ridiculous upside potential. Maybe it doesn't, right? This is a retirement stock to me. This is going to be the Disney of Japan, in several years from now. Maybe it takes 5 years. I don't know. I don't mind holding on to the stock forever. And if they announce the release of a new console, fantastic. Maybe I make returns sooner rather than later. So that's my take on Nintendo. I did do some DD on Wall Street Bets a while back. Maybe I'll put that link in the comments. It's a bit outdated, but it still has very relevant information, I think. My price target's probably changed, mainly because of the yen, this devaluation versus the US dollar, right? But overall, I think it still holds up. So, yeah, that's about all I have to say for Nintendo. Let's check out the comments. What you guys got? What's my cost average on Nintendo? I believe it is 55. Let me double check. Okay, 57. So, I'm good with that. Yeah, 57 is not too bad. Was it at 54? Yeah, no big deal. I mean, I was buying before the yen started dropping versus the dollar. I mean, that really was not expected because it's not like Japan's economy is, going into the shitter like the Eurozone. So I didn't expect that, but what are you going to do, right? But overall, nothing really changed for the company, and they're announcing a lot more video game releases. So I'm fine with that. Yeah, I don't mind sitting on a stock like this, even if the cost base is a little bit higher than market, right? Yeah. So UBS on air market or UBS on air market moves. That's the name of the UBS podcast I mentioned. Thanks for pointing that out. Let's see. Any concerns for the Japanese economy or currency and any effect it could have on Nintendo? I think maybe Morgan Stanley said this in the Thoughts on the Market podcast. Could have been UBS. I kind of agree with them in saying that the yen has dropped too much. I honestly don't know why the yen has dropped this much. The economy is actually looking pretty damn strong, and Japan has announced that they're ready to start supporting the yen, the value of the yen. So I think this is a low for the yen. So overall, for the Japanese economy, I don't quite get it why their currency has dropped so much in value, because the economy looks fine. They're actually chugging along just fine. Like inflation's like 2%, and there aren't really any problems in big China or big China. Oh god, big Japan. So yeah, I hope they're right. I don't really try to make those types of forecasts on countries, on global economies, right? What's the value of the currency going to do? But I am inclined to agree with Morgan Stanley or UBS, whoever said it, that I think the Japanese economy looks very strong, and I think the yen is kind of at a low right now. So all things considered, they should do pretty well going forward. I don't see why not. So hopefully that's a tailwind for Nintendo stock price, because I know it was a freaking headwind on the way down, because it was trading at like $70 a share. So yeah. So yeah, I'm actually, let's say I'm much more bullish than bearish on the Japanese economy. And again, I don't keep up with it 100%, but just looking at the value of the yen, looking at overall macroeconomic figures for Japan, they should do pretty well going forward. I'm not worried. I'll put it that way. I'm not worried about risk relating to Japan's macroeconomics. I'll put it that way. So those are the stocks I feel like covering today. Just those. You'll notice I have plenty of other stocks on my watch list. But yeah, I just wanted to talk about Earthstone, Stellantis, or we'll call it STLA, Visa, and Nintendo. I think, again, Earthstone, I think is a good maybe high risk, high return play. So calls, I want to limit my risk. And I do want to give it time. So if I can go out maybe mid next year, maybe that's a good time for him. Stellantis, I want to keep watching. I want to build a position. I don't care if the price moves up a little bit based on good news and markets start paying more attention to it. If they're making some moves, if they're making some good acquisitions, or if the Eurozone, the asset prices, stock prices just collapse, great. I am going to load up on Stellantis. That is one of the best bargains I have found on the market personally. So, yeah, really like that company. If I take shares, I'm getting a fat dividend too. So, yeah, very, very bullish on Stellantis. I probably want shares and calls over the very long term. So at least January 2024, I think, if you're looking at calls. Visa, classic value stock, very strong company, very strong fundamentals, a retirement stock for sure. Maybe not a multi-bagger. I honestly don't think they're going to be a multi-bagger unless you just, buy some YOLO calls, right? And then everything turns out fine for them. But yeah, just a classic, good old retirement stock. I think you cannot go wrong with buying Visa if you're a very long-term investor. And then Nintendo, yeah, just very good stock. I think it's a multi-bagger over the long term. I wish they had options because I would buy all the calls, right? They don't, unfortunately, but they're trading at a good value. I think the outlook for the Japanese economy is pretty solid. I think investors, markets, they're kind of, for some reason, they're ignoring Japanese stocks and Japanese markets right now. But yeah, and don't just take it from me. I'm not a macroeconomic expert. Listen to a few of those podcasts. Again, the Thoughts on the Market by Morgan Stanley, and as somebody already pointed out, UBS on air market moves. So, and there are other podcasts. I just like the ones that are a little bit more tight, more compact. I don't want to listen to 2-hour long podcasts. But they give some good information. And yeah, I agree with them on the outlook of the Japanese economy. I think investors I think they forgot that you can invest in Japan. So yeah, I think things are looking good for Nintendo. Aside from that, the theme parks, the media, software to hardware sales mix, and then inevitably they're gonna announce that they're working on another console, and it's probably gonna be damn good. So yeah, a lot of tailwinds for Nintendo, I think, and yeah, it's my biggest position stock wise. So yeah, that's all I got for today. I think it's a lot of information. I'll try to put some time steps. I keep meaning to do that in the videos just to make it more convenient for everyone. And aside from that, I'll share some of the links to the sites that I'm using, like ROIC.ai, ticket.com, here, economic calendar. There's some other stuff here. But like I said, I'll cover those in another video, going over all the sources I use, and I'll go into detail on my screening process overall. So yeah, hopefully I can get that video out soon, maybe within the next couple days, because I think it's probably going to help a lot for people that are kind of new to having their own process and seeing my spreadsheets, me talking about multiples, and you're probably thinking like, what the hell's going on with all this stuff, right? So yeah, I'll try to get that video pushed out soon. In addition to that, check out the video I posted about just my value investing style, because I think that'll help you to understand a lot of what I talked about today and what I'll talk about in the future. Other than that, I'll try to do some more live streams. I didn't have anybody from the Discord on today, but I got some stuff to figure out with Discord and integrating that into the live stream. So once I figure that out, I'll start doing those more engaging live streams. And yeah, until then, I'll keep doing videos like these, little value investing videos, if you will. And yeah, I'll get that other video out. Check out my other videos. Check out the disclaimer too while you're at it. Check out the intro video just to get an overview of who I am, why I'm doing this, and what my investment style is, right? So yeah, until the next video, I'll see you guys and gals. Have a good Friday. Have a good weekend. And yeah, until then, cheers.